Hello, friends. In the next few minutes, I'm going to take you through the key events of the recent past and UpperCrust PMS's view on equity markets and for its portfolio on for the month of October 2022. Markets in September witnessed significant volatility, majorly emanating from global developments. The first half of September saw markets rising continuously, the trajectory that had seen in July and August. At the midpoint of the month, small cap index was up 4%, mid caps by 3%, and large caps up by 2%. However, post the US Fed Reserve's meeting, where they noted the persistence of high interest rate in US to combat inflations, market corrected quite significantly. Europe continues to be beset with problems emanating from geopolitical developments, with gas flowing through the pipelines from Russia to Europe impacted the energy situation in Europe, and consequently economic activity remains very vulnerable. UK elected a new prime minister whose team presented a mini budget whose main highlights was tax cuts and stimulating the economy with even more debt. Both the currency and UK yields did not take it positively and corrected significantly in the light of these developments. These events further led to liquidity moving to the safer havens of the US dollar. Dollar index saw significant sharp up move this month, further impacting the risk sentiment with Indian equities and Indian rupee having outperformed significantly over the last 3 months as well as during the calendar year of 2022. This global risk off saw FIIs booking some profits and selling equities. The INR also weakened, especially against the USD. There were two or three major reasons. One, global commodity prices clearly are correcting in the light of the likely global weakness and potential recessionary outlook. With India being a large importer of this global commodities and especially the crude would be a beneficiary of this fall and another energy prices that augurs well for them. Secondly, European reliance on energy from Russia is likely or not likely to get resolved in the near term. Any build out, therefore, on alternate energy options will take 2 to 3 years at a minimum, with energy being the key input to manufacturing European facilities, risk being competitively unviable. Globally, historically, most European companies' capex was either in the Eastern Europe or to the China, and both these regions are likely to take a back foot for now. But it does appear that Indian manufacturing companies are in a good shape, having reduced their debt and investing in capacities for the future. Third reason being US and North American economy is short of manpower as recent employment trends indicate, and while the demand is likely to fall as large hike on interest rate pass on to the real economy, it does open the potential for greater offshoring to Indian companies. And lastly, the series of reforms initiated over the last few years, such as GST, RERA, tax compliances, and all has meant that domestic cycle is in a much better shape in India compared to the rest of the world. All this does not mean that we will not get impacted by the global factors, especially in the near term, but it is important to keep the bigger picture in mind while evaluating the investment choices, and in that context, India does seem very favorably placed. Clearly, the Indian outperformance this year, where we have fallen one of the least local currency terms, captures this growing sentiment. Valuations thus are above longer term 10-year average in India, even as the most other markets are significantly below their last 10-year average valuations. While global factors concede return of FII selling, domestic investors are pouring in fresh inflows through their monthly SIPs, EPFO allocations to equities, etc., does provide a reasonable cushion to absorb some of these outflows for sure. Global risks have gone up while the other direct impact on Indian economy is limited. Indirectly, India will definitely get impacted with a higher global cost of capital. However, these stress are transient and unlikely to impact the longer term competitiveness of the Indian companies. Given that ups and downs are a part and parcel of the asset class like equities, it is only natural to expect a higher volatility in the times ahead. However, rather than obsessing over the fear of fall, we would encourage investors to use each such opportunities to increase an allocation to equities, especially if one is underweight this asset class, which is normally the case for majority of the Indians, with disciplined asset allocation and with a focus on longer term goals, it is imperative and equity continue to be an important avenue to fulfill these obligations. In case valuations provide significant correction, we do advise investors to increase their allocation to equities in a systematic and disciplined manner. Be a patient investor and do remember time in the market is more important than timing the markets. Thank you and stay safe.